Hello everyone, I'm Jay Shah. Welcome back to our deep dive into ESG and climate reporting series. So we have already seen the basics from the terminology and history of the ESG and climate regulatory timelines of the ISSB and CSRD, and in last modules we have unpacked of IFRS S1 standards. So we have seen the module 1, 2, and 3, and now that we have those general standards in place, we are ready to move forward for the deep dive into IFRS S2, which is a climate-related disclosures. So welcome to module 4. We have covered the general requirements in S1, and now it's time to set a specific to this module's focus on IFRS S2. So the standard for climate-related disclosures, this is where the rubber meets the road. Climate is the first thematic standard because it is the most urgent and financial material risk for the majority of the companies globally in the world, and that is why the IFRS S2 has a mandate from the G20 and from the ISCO to generate this kind of IFRS S1 and IFRS S2 standards under the SASB, and specifically for the climate-related disclosures. So we'll see in much detail. So the objective of IFRS S2 is lesser focused. That is require you to disclose information about climate-related risk and opportunity. So that is useful for the investors. So we are not just talking about saving the planet. We are not talking about how the climate impacts on your cash flow or your financial journey and how to access the finance. So by the end of this sessions, you will be able to apply the 4 pillars that is based on the TCFD, Task Force for the Climate Related Financial Disclosures. So that is governance, strategy, risk management, and metrics and target. So specifically for the climate, that 4 pillar is very much important under the IFRS S2, and understand the critical role of scenario analysis. That is also one of the objective. We'll see in much details in phase 2 that how we are going to calculate climate scenario analysis, but we'll see the basic of climate scenario analysis. Build a transition plan, master the metrics, including the complex GHG emission scope 1 to 3, and also the finance emission, which is very important for the banking and finance industries or the investor industry. So we'll see this kind of stuff under the IFRS S2 standard, and we'll overview of this whole things in upcoming slide. So let's start with governance. Investors want to know who is steering the ships through the climate transition. So for the board, you must disclose which body oversee the climate risk. Is it full board, audit committee, sustainability committee? Is there any other committee? You have to crucially must disclose their skills and their competencies, what are they actually doing, and understand the climate science and the overall carbon markets, what are the carbon tax around the world, and how often are they discussing this. So whether it's a quarterly, fortnightly, maybe in 6 months, this whole board members or the committee is meeting and discussing the climate related stuff. And the second side is for the senior management or the management, which is about the executions on ground. So who is responsible for the daily assessment, for example, any kind of metrics of GHG emission scope 1 to 3. So who is appointed for those kind of risk? How are they held accountable for the various types of management? You need to describe whole stuff in terms of how your company's governance is working during your ESG reporting. So these lines that connect the sustainability managers in the factory all the way up to the boardroom. So that is very important part, that is governance, and you have to mention your vision, mission, and overall storytelling. Moving to the strategy, this is the heart of the IFRS S2. You must disclose the resilience of your strategies to climate change. How do we test resilience? Are you using a scenario analysis, or how you are using scenario analysis? You cannot just guess that IFRS S2 require to use climate related scenario analysis. So you have to describe and what are the mandatory scenario. You must assess a scenario that align with 1.5 degree global temperature, that has been increased, and based on the Paris alignment as well. So this is often called as a transition risk. You can scenario because it assumes the aggressive regulations and carbon pricing. So that is part of the transition risk. We'll see that what is the difference between the physical risk and transition risk. Entity specific scenario that you should also look at the other scenarios that relevant to your geography, and perhaps a physical risk scenario where temperature rise by 3 degrees Celsius or 4 degrees Celsius overall in the world, that might be leading to the severe weather events wherever your assets has been located. So you must disclose the assumptions you used, and most importantly, the result of that analysis. So whether your strategy survive the stress test or not. So that is part of the whole strategy. Now, scenario analysis tells you the risk, and the transition plans tells you your response. So you already calculate the scenario analysis. Now you have to plan your transition. So a transition plan is the aspects of your strategy that lays out your targets, actions, and resources for moving towards a low carbon economy. So you need to disclose the objectives. What are you trying to achieve? For example, net zero by 2040, 2030, 2070, based on the overall target of country. What are the actions? For example, what are you actually doing? For example, electrifying your fleet from existing diesel-based car, or you can do electrifying the energy through the coal-based power plant. What are the resources? How are you funding those resources? This is a critical. Investors want to see that capex committed to the plan, that how you are utilizing your capital. And finally, you must quantify the financial effect. What are the current effects? How is the climate change hitting your balance sheets of asset, or write downs from flood damages? What are the effects, current effects that help that hitting your balance sheet? And what are the anticipated effects, so that in future how will this impact hit your cash flow in the future, or you have might be a good transition plan so that it can increase the cost of carbon permits as well. So you have to change your transitions plan. So you have to be smart that how you are going to prepare your transitions plan to mitigate your financial impact. Now, how do you identify this risk that you mention in the transition plan in the first place? So this is the risk management where you need to disclose your process for identifying both physical risk and transition risk. So now what is physical risk? That is cover acute event like floods and chronic event like rising sea levels. So acute event that covers the suddenly the flood is coming up, and the chronic shifts, which is a slowly temperature is rising, sea level rising. So that is part of the chronic risk. And the transition risk, which means in some of that countries policies has been changing over the time. New technologies are coming up, reputations are hitting up. So those are part of the transition risk. For example, in Europe, there are so many of ESG sustainability and regulations are coming up. So that is the policy changes, and based on that, lots of corporate companies needs to be report to the government. New technologies are coming up because of this whole policy changes. Reputations hits. So in USA, Trump administration has massive changes in tariffs. So there is a reputation hits for the various companies in USA and your other parts of region. So, but here is the most important word that utilized in IFRS S2, which is a word uh, on this slide is integrations. Climate risk cannot live in silo. You must explain how this process are integrated into your overall enterprise risk management. So you have to integrate physical risk, transition risk into the overall risk management, and try to answer the questions that does your climate risk register talk to your financial risk register or not. If not, then you have to ask to your company, and you have to do together for financial risk and with climate risk. So we have the strategy. Now we need the numbers. So IFRS S2 requires two types of metrics. That is, one is core metrics. These are required for everyone, like GHG emissions, scope 1 to 3. and industry-based metrics. So IFRS S2 requires you to consider SASB standards for the industry-based related metrics. So if you are in oil and gas, you report differently metrics than if you are in banking or the financial industry. So this ensure that comparability within your sector. So here, SASB standard is very important. You can download from the IFRS website, as well as the SASB standard is already available. And the purpose is the industry specific decision useful information for the E, S, and G, so that you can see those kind of stuff. And the integration is there, that industry based metrics complement to each other for the cross industry metrics. So scope 1 to 3 is very much common metrics for every sector. So that is provide a comprehensive view of climate related performance and the exposures for the metrics and targets related stuff. So the big one, of course, is greenhouse gas emissions metric. So you must disclose absolute gross emissions in metric tons of CO2 equivalent. We'll see in phase 2 that how scope 1 to 3 emissions can be calculated. We'll see the basic. What is the scope 1 is direct emissions from your sources you own, like your factory, chimneys, or company's car. So those are the part of the scope 1, that is direct emissions. Scope 2 is indirect emissions from the energy you buy or you purchase. So electricity, heat, stream, those are the part of the scope 2. And scope 3 will be the everything else in your value chain. So that covers your supply chain from upstream and the use of your product at downstream. So how do you calculate this? We'll see in much details during phase 2. IFRS S2 is also mandates for the GHG protocol. So it is the global standard. And for the scope 2, here you have to note that you must disclose both location-based and the market-based methodology for the scope 2. Location-based is the average emissions of the grid where you are operate. For example, in USA, your emissions factor will be different rather than you are in London in UK. Market-based emissions factor, market-based methodology that reflecting your specific energy contracts like renewable energy, green energy certificates that are giving your energy providers. So that is covers different emission factors in terms of market based. And for the scope 3, it is very much complex. Definitely you must disclose which of the 15 categories. Scope 3 calculations covers 15 categories. So you have to disclose that which of the 15 category you included and acknowledge your estimations or the uncertainty or the assumptions that you have taken. So if you leave a category out, you need to explain why you leave those particular category. So beyond the emissions, IFRS S2 is also asked for the financial metrics because definitely it's a financial related impact reporting. So that show you you are serious and you are connecting your climate risk with the financial risk. For example, internal carbon pricing, that is, do you charge your own business units for their carbon? If so, what is the price per ton? So that is part of the internal carbon pricing. The second is capital deployment. How much capex are you actually spending on mitigations and adaptations project? Then third one is a vulnerable assets. So what are the percentage of your assets are into the physical risk? For example, how much percentage of your assets or your factories or your buildings in the flood prone zone area, where there is a flood risk zone is very high. So that is part of your physical risk. Or for example, where your assets located where transition risk is very much exposed. For example, your assets is located in Germany, where coal-based power plants are there, and those assets can be part of your transition risk, because in Germany there is a regulations that every coal plant has to be shut down. So that is part of vulnerable assets that needs to be disclosed. A quick note for my friends who are working in banking and asset management company, you have a special requirements under the IFRS S2, that is scope 3 under the finance emissions. So your scope 3 says essentially the emissions of the companies you lend or do or invest in. So you must disclose this absolute emissions. Transitional relief, that is for everyone. If you are feeling overwhelmed, remember the reliefs we discussed. So scope 3 relief, you can delay the scope 3 reporting for the first year. Second, also the scenario analysis relief. You can also delay the complex scenario analysis for 1 year. That gives you a good runway to get your data ready. So these are the summary of financial institutions as well as the transitional relief for every company. And to wrap up the module 4 of IFRS S2, remember that IFRS S2 is designed to make climate change visible on the balance sheet, connect with the financial risk. So first pillar is governance, put the board in charge. Strategy, that is stress test your business within scenario analysis. Third is matrix, which is measures your full carbon footprint, including scope 315 categories. This is the robust framework and it moves us from climate storytelling to the climate accounting. So please ask if you have any questions regarding IFRS ISSB standards. ISSB is the most common standard used by every country because it's a mandate from the ISO and G10 for the reporting work at every stock exchange level. So in India, in UAE, in Australia, in New Zealand, in Hong Kong, in Malaysia, in Singapore, every regions are adopting ISSB standards. And in the next module, we will see the horizon beyond the climate and look at the CSRD and the ESRS aspects of European standards that are a little bit different than the ISSB standard, which is almost adopted by other countries. But in Europe, that CSRD and ESRS is the European standard for ESG sustainability and climate reporting side. So I will see you there. All the very best. Thank you.